Hi everyone, I'm Alexandra Bertomeu-Gilles, a not-so-traditional actuary. I actually started my career in the cradle of the insurance industry in London, working in P&C reserving, capital, and internal modeling. It's in 2017 that I discovered blockchain and it completely changed my perspective. Within 6 months, I was stopping my job and dedicating myself full-time to studying blockchain, this technology that I believed would change the world and change the financial services as we know it. After a few years of studying in and working in the industry as a freelancer, I'm now risk manager at Aave, a blockchain-based lending solution, what we call in the industry a lending protocol. What is a lending protocol? It's an online application where you can leverage your assets by borrowing against them. And Aave is part of this emerging financial infrastructure that is called DeFi. But what is DeFi? We'll go over the core values of DeFi and some of the tools available. These are very exciting times for DeFi. Innovation is creating new opportunities every day. But what are the risks? We'll look at some examples of major losses as well as some of the key risks of the industry. And finally, we'll see how do you build risk standards from ground up in a new industry where they don't exist yet. So how is the ecosystem trying to adapt and to understand better its risks? We'll see also what we're doing at Aave with the Aave risk framework. And finally, we'll cover one of the paths that the industry has chosen, which is decentralization, and which is a great tool for risk management. So what is DeFi? Currently, there's around $10 billion locked in DeFi. And DeFi as a whole has the ambition of taking over the financial services. However, I wonder how many of you looking at this video already know what is DeFi. And I'm sure not many. So let's have a deeper look into what is DeFi. It stands for decentralized finance. And another name commonly used is open finance. So it's an alternative financial system on the blockchain where you can do complex operations within minutes anywhere in the world. You don't need a banker approval. You can send millions within minutes. The only thing you need is the internet. So let me walk through some concrete examples so you understand better the whole possibilities. Meet Alice. Alice has $10,000 and she wants 1,000 euros. So she definitely has enough funds to cover these 1,000 euros she wants to change. So in the first scenario, we're going to go through the traditional path at a bank. Alice calls her banker and explains the situation. Well, the banker explains that first she needs a euro account. So the first step is to set up this euro account at the bank. It can take a few weeks. The banker gets back in touch a few weeks later when the account is set up. Then there is no euros in that account, so Alice still needs to change her USDs for euros. This can be done via bank exchange. So Alice sends the funds to the bank. The bank traders will exchange these funds on the markets and return the 1,000 euros to Alice. Overall, this process is going to take weeks. It demands various exchanges with the bankers, and it can as well be costly because there is a lot of manual operations. Revolut, a neobank, has started to solve the problem, and through its mobile application, you can access and exchange up to 35 currencies at the best interbank rates. And now let's look at what you can do on DeFi and more specifically on Ethereum. Well, there you have access to hundreds of tokens. In this example, Alice wants to change USDs in euros. So there are some cryptocurrencies whose value replicates the price of USD and euros, and so this is what we're going to use in this example. So Alice has 10,000 USDCs, so it's a token which value is equal to $1, and she wants euros. So she wants EURS, a token whose value is backed by euros. So the first step for that is to open your laptop and to connect to the website of a decentralized exchange. So this is called a DEX, and so this is a DeFi exchange, which is decentralized like the rest of DeFi. On that website, Alice can directly connect her wallet. She doesn't need to register to the website. She doesn't need to upload any ID. She just connects, and automatically the application can read the funds in her wallet. Once she found the pair she wants to swap, she selects the pair, chooses the amount to swap, and straight away she can see the market price and the potential slippage in price. That's it. Once she has selected the criteria she wants for her operation, she selects and approves the transaction, which is then sent to the market and happens within minutes. This means that Alice is directly interacting with the markets. She's free to look at the different available markets and find the best rates, not only in terms of exchange rate, but also in terms of fees. Now, let's take a more complex example. Let's say Alice needs a new car. She's already got a house that she's nearly paid off, but now she also needs a car. Still, she also needs a roof over her head, so she needs to keep the house. In the traditional sector, what you could do is get a mortgage to borrow against the property you have. So this will give you some liquidity for different spendings while keeping the house. The process is pretty long. First, you have to reach out to different mortgage providers and check which one offers the best rates. Then you have a lot of paperwork to fill. ID checks, proofs of residence, credit scores. The mortgage provider will look at everything before approving the mortgage. Overall, this process can take weeks, if not months. So now, let's look at how that works in the blockchain space. Instead of having a house, let's say Alice has some Ethereum tokens, and she needs to borrow against these Ethereum tokens. So Alice will connect to a lending protocol such as Aave. She can deposit her Ethereum on the Aave platform. As she deposits these assets, they're pooled with the rest of the funds that have been deposited on the protocol and which are lended out to borrowers. So as a depositor, you get yield on the assets you've deposited on Aave. Now, Alice also wants to borrow, so she can choose to define these deposits as collaterals, and she can borrow against them. So you can only borrow less than you've deposited. Here in Aave, you can borrow immediately against her collateral. She doesn't need to go through any specific registration, ID check, KYC. No need to look at the credit scores. The borrow is instant. And so Alice has straight away the liquidity to pay for her new car. One thing that's also very powerful on the blockchain is that the blockchain is a ledger that keeps track of all transactions. So Alice can really look at her wallet and understand exactly which operations she's done, how much fees she's paid, what was the exchange rate at the time. Everything is recorded. And so here are starting to stand out the three core values of DeFi. DeFi is permissionless. You don't need to register or to share your identity to use it. DeFi is decentralized. There is no intermediary. You can interact directly with the financial product and have nearly instant operations. And finally, DeFi is transparent. All the operations are recorded on the blockchain. These core values are rather an ethos, a destination. That is to say that not all projects are quite there yet. It's a spectrum from old finance, old fi, which is the traditional institutions such as Société Générale, to CeFi, centralized finance, which is starting to move a bit towards technology to provide faster services. For example, Revolut, who is a neobank accessible from your mobile only, and which provides cryptocurrency investments. And at the end of the spectrum only do we have DeFi, decentralized finance. One of the key components of the DeFi space, and which really creates the foundation of a financial system, are stablecoins, which are fixed price cryptocurrencies. There are different types of stablecoins. The majority of them, of the stablecoins, is backed, so it's collateralized assets. They can be either backed by US dollars in a bank account, in the case of a stablecoin that's equal to $1, or they can also be backed by crypto assets. So the ones that are backed by, when backed by US dollars in the bank account, you have a lot of stability, whereas crypto assets are volatile, so this creates stablecoins that are pegged rather than exactly fixed at a value. And so these stablecoins have three key properties. So their value is fixed. So this means that you can use them to hold your savings and to store value. Then their value is $1. So the dollar is is a universal currency, and pretty much everyone in the world knows what $1 is worth. So it's a unit of account. And finally, the stablecoins hold large volumes of exchange among cryptocurrencies. So they're definitely used as a medium of exchange. And these three properties, they're the three properties of money. So stablecoin are emerging as an alternative form of money, a peer-to-peer cash system. But beyond stablecoins, there's now a full range of decentralized banking services available on the blockchain. You can have a bank account in the form of an e-bank account, such as Monzo provides, for example, where you have an app on your mobile phone where you can hold different assets. Then you can convert them to fiat currencies, so euro, for example, and you can pay directly in the shop with a Visa card. You can also leverage your assets, like we've seen for Aave, through lending protocols, where you can deposit your assets and borrow against them. Then you also have access to very sophisticated investment strategies, whether quant strategies, where your portfolio rebalances based on different quantitative indicators, or yield optimization strategies. And the yields can be really high, much higher than the yields that we get in banking. Do you have any idea what kind of yields are possible in DeFi? Well, in this example I found on Harvest Finance, they offered 719% yield for a limited time, of course. But doesn't that sound a bit too good to be true? Let's recap a bit where we're at. So DeFi is an alternative financial system on the blockchain. It offers basic and complex services and potentially very high returns. As actuaries, we know the trade-offs of very high returns. Return equal risks. So if there is a high return, there is a high risk. Let's look at the risks of DeFi. It's good to keep in mind that this is the very beginning of DeFi, and generally speaking, it's also the beginning of blockchain. Bitcoin was invented 11 years ago, DeFi just 3 years ago, so a lot of these projects are still experimental, and it's the first time that they enable these kind of operations in such ways. This is why one of the first advice that's given when someone invests in cryptocurrencies is only invest what you're willing to lose. There's a lot of risks, and there is risks of losing your capital. How wrong can it go? Well, when I say losing your capital, this can happen very simply without even an attack. Your capital is secured with your private key. That's an alphanumerical number, a unique alphanumerical number that gives you access to all your funds. If you lose that key, you lose access to your funds. And hundreds of millions have been lost in such a way. I was looking, there's actually quite a lot of news article about the subject, and individuals losing, for example, James Owens, he lost $16 million in Bitcoin because he threw out the wrong hard drive, and by mistake threw out the hard drive that contained all of his Bitcoin keys. Lots of examples of this happening online. So that's the downside. More control means more responsibility, but are we able to handle that responsibility? And then things also go wrong due to some mistakes in the codes or due to some hackers. So there's been quite a few major hacks in the industry, ranging from just a few $1 million to tens of millions of dollars. For example, this year, Landef.me got hacked. What happened? Well, they added to their offering an asset that was not compatible with the smart contract code they had developed. And so this created a vulnerability where an exploiter was able to manipulate the balance of assets. And so this completely changed the balance of the protocol, and eventually the attacker was able to siphon $25 million. And these kind of hacks are frequent. You can look into more detail, but some of the other examples are the DAO hack, which was the first major hack on Ethereum, with $50 million robbed. And so to understand better these hacks, we need to look at the key risks of a DeFi protocol. There are two main types of risks. The internal risks, which are really specific to the protocol itself. And this covers smart contract risk, which is the risk of the code not behaving as intended. Incentive failure risk, which is a system risk where the financial rewards are not enough to incentivize the good behavior, and so the community is not getting involved enough to support the system. And finally, the governance risk, which is the risk linked to the control of the protocol. If an entity or an individual has control over the protocol, ultimately, to some extent, it enables that entity to steal all the funds. So that can be a big risk to its users. And then there are also external risks. Some of the external risks that are important are the market risks, especially the cryptocurrency markets are more volatile than the traditional markets, and things can change really fast. So this is a very key risk to take into account. There is also the composability risk. So as I was mentioning earlier, DeFi protocols interact and depend on each other to build more complex solutions. But so this means that if a protocol is connected to another protocol and that underlying protocol fails, well, that risk is gonna compose into the parent protocol. And all these protocols, they're built on the Ethereum blockchain. So they all rely on the blockchain operating well. And that's the network risk, the risk of the blockchain. And finally, a risk that we as actuary are quite familiar with, the regulatory risk, which takes a different shape in the DeFi industry, because at the moment there is not much regulation that fits perfectly DeFi. So regulation is still being built, and that creates a lot of uncertainty for the space. And so these are all significant risks that need to be understood and managed. And so the industry needs new risk standards, and since it's just at its infancy, we're going to have to build these risks. We're building these risk standards from ground up. So just in 2020, DeFi has grown from $500 million to $9 billion. The stakes have become really high, and so the industry really needs higher standards. Let's look at some initiatives that have started to emerge in the industry. So how do you assess DeFi? How do you assess the risks? Auditors have been taking a bigger and bigger part in that aspect. Here in DeFi, it's technical auditors, so they review and test the codes of the smart contracts. However, a technical audit is not bulletproof. Audited projects are still subject to hacks. So it's quite, when you're not a computer scientist and you don't fully understand these audits, it's kind of hard to judge whether they're all at the same level. So there's definitely a need to standardize these audits and also make them a requirement. There's been also some projects that are trying to compare globally the different options out there, such as DeFi Score, which has created an open framework to evaluate DeFi protocols and to help users select the best protocol for their risk appetite by providing a risk rating for each of the protocols based on different criteria. And then finally, there's Nexus Mutual, which is a great risk management tool for DeFi and provides cover for the different protocols. And so its risk assessment method is based on a decentralized risk assessment. So members of the mutuals are invited to stake assets in the protocols they believe in. They're in the way vouching for the protocols they believe in and saying that the risks are acceptable. At Aave, we're also trying to raise the standards of risks, and we've published a risk framework where we look at the different risks of the protocol around some key risk factors, such as the asset risk, the liquidity risk, or the solvency risk. So the asset risk covers the risk emerging from the assets integrated in Aave. And so each asset that is integrated in Aave carries its risk within the protocol and puts all the funds held by the protocol at risk. So it's really important to make sure that it's safe to integrate a new asset, and it's also important to monitor closely the 20 assets that have been that are currently part of Aave markets, because the risks can change really fast in DeFi. To assess the safeness of these assets, we use three main risk factors. So smart contract risk, which we've covered before, is the risk of the smart contract not behaving as intended. And this risk is quantified by looking at how battle-tested a contract is. So looking at the maturity, the number of transactions, and based on that, we quantify a risk rating. The counterparty risk is also very important, and that corresponds to the governance risk we've discussed previously. And for this risk, we look at the level of centralization, so the number of parties that control the protocol, as well as the trust level. So how much trust is there in the entity, project, or processes that govern the protocol? The last risk factor is market risk, which is a risk I've started to work on in my actuarial career. However, here the tools are adapted to the crypto markets. So the risks, the sub-risk factors I'm looking at is the market capitalization of an asset, the liquidity of an asset on the markets, because when things go wrong on Aave, the collaterals need to be liquidated, so you need a decent amount of liquidity available. And finally, the volatility risk, which is quite important because the collateral needs to be able to cover the borrows even in periods of high volatility. And so this scoring methodology I've developed for Aave's risk framework is inspired by the scoring methodologies which are part of the actuarial toolkit and which I've used many times in my traditional actuarial career. And once we have the risk quantification, we can mitigate some of those risks with the risk parameters of the assets integrated in Aave. So first of all, you can choose whether an asset is just a borrowed currency or also accepted as a collateral. And collaterals are specifically risky because collaterals secure the solvency of the protocols. They correspond to the assets of the protocol, whereas the borrowers are the liability. So collaterals need to be financially trustworthy to be able to handle the solvency of the protocol. Another key parameter is the loan to value. So the loan to value defines how much you can borrow for a specific collateral. For example, the loan to value of the DAI token is 75%. This means that you can borrow 75 for every 100 DAI deposited. So if an asset is very volatile, the loan to value is going to be smaller to allow for more market fluctuation without threatening the solvency of the borrower. Another key part of the risk framework is the liquidity risk. One of the key factors of DeFi is that users keep control over their funds. But when you keep control over your funds, what does that mean? It means that every protocol must allow instant operations. However, when there is no liquidity, it's not always possible. Here on Aave, depositors deposit their currencies, their assets in the Aave protocol. Once they're deposited, they generate a yield by being lent out. But if all the funds are lent out, this means there's no more funds for the depositor to withdraw. And this is when we have a liquidity crush. So the liquidity can be measured as the inverse of the utilization. Here in the table on the slide, the liquidity crush happens every time the utilization reaches 100%. So it actually happens for very short periods of time because the market readjusts. And so one of the tools we have to ensure that the liquidity crushes and to ensure that liquidity is available is the borrow interest rate model, which defines the cost of borrowing an asset. So this borrow interest rate model is developed. The borrow interest rate is based on the utilization of the reserve, and so past the level of optimal utilization, the interest rate will rise sharply. And so this means that as capital becomes scarce, the cost of capital increases, and so it becomes more expensive to borrow. This has two main objectives. First, to incentivize borrowers to repay their loans, because now it's become very expensive to borrow. Here, for example, if you look at the graphic of the DAI borrow interest rate curve, at full utilization, 100%, the borrow rate is over 150%. So borrowers are paying at full utilization 150% interest rate per year. So that's quite a good incentive to pay back. And then in this situation, the depositors are also getting 150% APY per year. So this is also an incentive for depositors to provide more liquidity to the reserve. Another major risk management tool that is omnipresent in the DeFi industry is risk management through decentralization. And so this allows to completely remove all single points of failures. And so this is possible through these new types of organizations called decentralized autonomous organizations that are smart contracts that are governed by their members. So how does this process work? Well, there is a governance forum where anyone can participate. You have an idea, you want to add this new asset, you just do a post, provide the technical analysis, and then the debate starts. When a proposal gets enough support, it's officially submitted to a vote, and so the token holders vote to approve or decline all the proposals. Of course, this means that you need the community to get involved, and so financial incentives are provided for those who have good behaviors. So this is a system where you align the long-term incentives and you also benefit from the wisdom of a very diverse crowd. And this is the route that we have decided to follow at Aave with the Aavenomics, which is our proposal of financial incentives for the decentralization of Aave to align the shareholders' long-term goals through a positive feedback loop. And so this means that the Aave team is going to give up all the power it has over the Aave protocol, and that in the future, all the decisions are going to be taken by the token holders through decentralized governance. In this Aavenomics proposal, we also suggest systems to make the protocol safer and more sustainable, among which we have, in this system, there is the safety module, where we build a line of defense against the risk of insolvency. So what does that mean? That means that the first barrier is a liquidity pool that can be punctured to refinance in case of default. The second line of defense is the backstop module that can also be used to refinance a deficit. And the last line of defense, the last resort, is the recovery issuance of new tokens, of new Aave tokens that will help recapitalize the protocol. And so here, what's really important is that all the users that decide to participate in making the protocol safer, and so to deposit their tokens in these liquidity pools, they're financially rewarded. And they are paid, they receive Aave token as a reward for taking on these risks for the protocol. And this process is called safety mining. So we're arriving towards the end of the presentation. I hope you have a better understanding of what is DeFi and its risks. I also hope to have shown you that the tools we master as actuaries are very useful tools in all industries, and that it's up to us to adapt and to learn the different skills required to understand different ecosystem and to be able to apply these new skills. The future is decentralized, and DeFi needs experts like you to help it shape its future and make it a safe financial system. It's very rewarding to work directly with users and have a direct impact on the way a system is run. Please join the conversation with Aave and the team. Thank you.